and I will upload it on the YouTube also.
Okay, that's a good thing.
Ji.
We just started YouTube live stream also.
Sure.
Yeah. If Yatindra has joined, so we'll maybe wait a few more minutes and then we can get going. So already there's a few more questions. Seshu just posted a question. So
Yes, did India has the concept of LLC for tax purposes, bookkeeping, P&L deductions on individual entities rather than individual persons holding the property. Can we keep and maintain investment earnings in India and US completely? That's true. What experts opinion on this topic? The third one again, it is a myth. अभी आपने म्यूट करा हुआ है?
एक minute. Hello, Seshu. So we have Yatindra and Seshu. We'll give it another couple of minutes and we can get going. Okay, Seshu is typing in chat. Okay. All right. So let me switch this and start the screen sharing. Start screen sharing. All right. Let me see. So, do we want to start or give it another few minutes?
As you like.
Huh?
We can wait for 2-3 minutes more.
Yeah. Let's give it 2 more minutes and then we'll get going. Where are both of you guys? Yatindra, Seshu, are you close to Milpitas, somewhere else?
I'm in East Bay, San Ramon.
Oh, okay. San Ramon.
And I was there in Milpitas earlier. I mean, 5 years before 5 years. Yeah.
Okay. Okay. Yeah, we're in Milpitas. We've been.
Where in the Milpitas?
Yeah, we're in Milpitas, close to the hills.
Oh, okay. Towards that side, yeah. Okay.
I've been here since 2009.
Okay.
Yeah. So we have a couple more people joining in. So we'll give it another minute. We'll start 5:05. Hello, Rashmi. Hello.
Okay.
Okay. So I will keep 2 chat windows, one on WhatsApp and one on this thing, and we're also streaming on Zoom or on YouTube. So, okay, I want to start.
Yeah.
Okay.
Yeah, please.
Let's get going.
Okay. I welcome you all to this small webinar on golden rules of investment, succession, and inheritance planning. I'm glad to see all of you on this. The agenda of the today's webinar is saving and investment fundamentals, exemptions on capital gains, succession and inheritance, will and trust planning for NRIs, and remittance of money to USA. To start with, the first and foremost thing is about saving. We all that savings in our life is necessary for protection of our family, for our retirement planning, and to maintain the liquidity. But the whole difficulty is if you find it difficult to save because of the compulsory outgoings from our earnings on account of our grocery bills, on account of mortgage installments, on account of fee of our children, and all necessary expenses. And then comes the discretionary expenses, and last comes the saving. If we manage to put the savings in the first category, that is compulsory savings, then we can save a lot of money, and it can multiply over a period of time, because the principle of compounding, which is considered as the eighth wonder of the world, works. So when we save, the next thing comes to our mind is about the investment. When we think of investment, first of all, we should think of the security of our principal amount. As has been said by Warren Buffett, that first and foremost thing is that one must ensure the safety of the capital. This is the first rule. And the second rule is one should not forget the first rule. So safety of the capital, as far as it is considered in the case of bank deposits, we have seen that in number of cases, banks goes into liquidation. So first and foremost thing we must consider while putting our money in bank account is that whether the bank is covered by the insurance scheme, whereby in California, I am informed that up to $250,000 of dollar per account per bank, it is insured. The first thing we must ensure it, and one must ensure that it is per bank and not per bank account or per branch. That is the important thing. While in India, the limit is 5 lakh per bank. That is the security provided by the insurance agency, which is connected with the bank. In order to check whether the bank in which we are having our deposit is insured or not, one can go to the website, and there the information regarding the security is available. Second comes the liquidity. Whenever we make investment, we must ensure that we are able to get our amount back as and when needed. For example, in the case of real estate, the amount is not easy to get back in case of need. Same is the case in the case of investment in shares, where the money is stuck. So for these type of investments, one must consider making the investment of surplus money, which is not required for next 5 to 10 years. Other amount can be put in different asset classes, which are easily available for liquidation as and when the need arises. Third point, which comes for consideration in this sequence, is the return on the capital or the investments we have made, because the primary object is to earn out of the investments made by us. So return depends upon the risk we are taking or the informed decisions we make. If we make informed decisions and take calculated risk, then we can increase the return on our capital. Then comes the tax incentives provided on the investments made by us. There are different incentives. For example, in USA, there is a health saving account in which if we put money, then the scheme provides for health insurance as well as the investment. And some of the employers are also contributing to this scheme. And over and above this, there are tax incentives. So one must consider these type of investments which has multiple benefits. Then the age of the person making the investment is also important. if the person is younger, then in that scenario, he can make investment for a longer period of time. And then the investment is one time or recurring in nature. For example, in the case of SIP of a mutual fund, the investment is made periodically, and it is one of the best method of saving money and creating wealth in the overrun, because every 1 month money goes for investment, and sufficient time is provided to the investment to have its growth over a period of time. Then one must consider the special incentives which are provided by the banks and the mutual funds while making the investment. Some agencies are providing special benefits on the opening of the account with them in the case of demat account or other accounts. So before taking a decision, one must compare these different options which are being provided. Then one must not make the investment and forget about it. One must make periodical review. And if required, if one finds that the investment is not giving the proper return which was expected, then he should reschedule the investments. Likewise, if one has taken a loan from a mortgage of his residential house, then after some years, one must consider whether to continue that mortgage or to go for refinance. Because over a period of time, when this mortgage installment is paid, then the amount of loan is reduced. Secondly, the price of the house increases, and simultaneously, as a normal phenomena, the salary of the person also increases, and the credit rating of the person in normal course, if he is making regular payment, also increases. In such scenario, if he opts for switching off to another lending agency, then he will be able to receive the money, mortgage money, at a much cheaper rate of interest. During last visit to America, I was successfully able to do this restructuring of real estate and was able to reduce the mortgage period by about 5 years. So this is one thing which can do wonders for the person. Then one must consider the net earnings out of investments. After making the investments, out of the earnings we receive, there are certain outgoings. For example, in the case of house which we have given on rent, there are outgoings on account of maintenance charges. In case of investment in mutual fund, there are charges levied by the mutual fund houses. For example, in the case of passive fund, the investment charges levied by mutual fund are very, very nominal, whereas normally the charges levied by the mutual funds on actively managed funds are much higher. Therefore, one must consider what he is getting net in his hands in the case of investments. Then last point, as far as the investment is concerned, is the diversification. As the old saying goes, one should not put all his eggs in one basket. The principle is simple. At no point of time, all the assets appreciate or all the assets depreciates. Sometimes the share market goes up, then the prices of silver or gold comes down, or the prices of shares increases. If one puts his money dividedly in different kind of assets, then even if one asset is not able to perform properly, the other assets will perform, and then the net result will be a gain. One may also consider putting 15%, 10 to 15% of his savings in the form of gold and silver bars, because in times the prices of gold and silver bars also increases, and it is very easy to liquidate these kind of assets in kind of requirement. Then the next topic comes in this series is the exemption on capital gains. Then if a person is having any capital asset in India of his own, or he has received from his parents, then one must consider whether it was acquired on or before 1st of April 2001, or it was acquired afterwards, because the base price as per the latest income tax laws in India, is if it was acquired prior to 1/4/2001, then the value, government value, which is the guideline value or the circle rate for stamp duty purposes, is taken as the base price. And if it was acquired on or after 1/4/2001, then the cost of acquisition will be the actual amount paid as per the registered sale deed. Then to this amount, we have to add whatever has been incurred after acquiring the property, say for a renovation or for improvement of the property. So that will be the cost of acquiring the property plus cost of acquisition. And there is a system of indexation of the property. For example, if the property value as on 1st of April 2001 was say 10 lakhs, then the index value as on date, as per the index provided by the CBDT of income tax, is about 3.25 times. That is, it works out to be 35 lakhs. And suppose if the property is sold for say 40 lakhs, and if we have incurred 1 lakh of rupees on account of executing the sale deed for brokers payment or for other payments, then out of 40 lakhs, 1 lakh will be deducted, and the net realization will be considered as 39 lakhs. And out of it, 35 lakhs will be deducted, and only 4 lakhs will be subject to capital gain tax. Some people have the misconception that the original cost minus the sale consideration will be the gain, but this is not the case. Then there is a set formula given in the act itself, and by taking advantage of these formula, we can reduce our tax liability to a considerable extent. Then we must consider the rate of income tax on long-term capital gain in India. At present, it is 20% plus surcharge. But in the case of sale of any primary house in the California, up to $500K, it is exempt. While in India, if one sells a residential house property and purchases another residential house property, then no capital gain tax is levied. And the second option is, if one sells any residential house property in India, whether used for self-residence or it was let out, in either case, if we invest that amount of capital gain in government bonds for 5 years, then no capital gain tax is levied. So these are two options which is available in case residential house property is sold in India and the amount is invested. So a lot of saving can be done in this case. Now, if one is not willing to make investment out of the sale proceeds or in either in new house or in bonds, then the liability of capital gain, as we have calculated in the example given, arises. It is 20%, as I have said. And in the case of NRI, the withholding tax is 20% plus surcharge. If an NRI calculates his liability, actual liability, which works out to be less than 20%, then he has the option to approach the income tax authorities for a certificate to the effect that the tax liability should be not 20%, but lower than that. And if the submissions made by the concerning person is acceptable to the department, then they will issue a certificate. And in that case, that reduced rate of tax, withholding tax, will be applicable in his case. So this is an important provision as per the Income Tax Act, which one must take benefit of, because otherwise the money will be blocked for certain period. However, in India, nowadays, it is very easy to obtain the refund after filing of the ITR. Now that the next topic is in the series is succession and inheritance planning. If a person has had any self-acquired property and he dies, then in that case, the basic question arises is whether he has made any will during his lifetime or whether he has not made any will. If he has made any will, then his estate will be distributed according to his will. Suppose he had his wife behind him and a son and a daughter, and he had made a will that all of his property will go to his spouse only. Then son and daughter will not get anything out of the estate of the deceased. But if he has made a will that all my property will go equally between the son and the wife, then it will be divided accordingly. Or he may made a will that each one will get one third, so it will go accordingly. In some cases, it is seen that he is not satisfied with his family members and he makes a will in favor of a charitable institution. So if it was a self-acquired property and he makes a will in that fashion, that none of the family members will get anything out of his estate. So one must be careful about the will which he makes. And second is the scenario where no will is there. If there is no will, then in that case, the property will be distributed according to the personal law to which the person belongs. In India, the personal law is mainly in two categories, divided in two categories. One is Hindu law and another is Muslim law. Hindu law covers even Sikhs, Parsis, and Jains, and Muslim law covers all Shias and Sunnis. As per Hindu law, if there is no will, then the property is distributed amongst all the legal heirs in equal proportion. The law has changed to the extent that even if the daughter of the deceased is married, even then she will have an equal right as of his brother in the property of the father. Suppose Mr. Ramlal expired and he had a wealth of 30 crores. Then his wife, son, and daughter, in the case there was no will get one third each, 10 crores each. That is the position. Even there is some misconception that if the daughter has came to USA and he has settled in the USA, then he will not be entitled to any share in the property. That is not there. As per law, even if they have settled in USA, they will continue to have their right in the property of his father if there is no will. Now, another scenario comes when the person who is no more had a property other than his self-acquired property. That the property he acquired from his forefathers. That is technically called ancestral property. So, in the case of ancestral property, every individual who is there in the family, spouse, son, daughter, they will be entitled to equal share. The same principle applies. Even if the daughter is married, he is settled in USA, even then, as far as the ancestral property is concerned, she will have an equal share, equal to his brother and mother. Then, as far as the will is concerned, we may broadly divide the will in two categories. One is living will, which is the concept in USA. In India, the law as far as living will is pending before the parliament. It has not seen the light of the day as of now. As far as the living will is concerned, in California, it is called durable power of attorney, and it is of two types. One is in respect of assets, and one is in respect of health care. And as far as general will is concerned, that concept of will is if a person during his lifetime makes a declaration that in the event of his death, his self-acquired property should be divided in the manner laid down in the will, then that will prevail for all legal purposes. And the person making the will is called the testator. The main point to be considered is the person making the will should be legally capable of making the will. To be brief, he must be more than 18 years of age and he must be in a sound state of mind. As far as drafting of the will is concerned, it must be in writing. It must be dated. Then there must be a date in the will. And second, most important thing is there must be a beneficiary mentioned in the will to whom the assets will go. If the beneficiary in the will happens to be a minor, then a guardian must be appointed to take care of the interest of the minor during the minority of the concerned child. And there must be at least two witnesses to the will. There is a myth that the witnesses should know the contents of the will. It is not the reality. Witnesses are only witnessing that the person making the will has signed in their presence. They need not know the contents of the will. And last person in the will is executor. While executing the will, one should appoint one or more executors to take care of the execution of the will. And they must be the persons of his confidence. The beneficiaries can also be made as the executors. They have been interested, they are interested with the liability for the execution of the will. And preferably, the executors should be of younger age, so that in case of need, they can execute the will. Probate of will in India is required only when the property is situated in cities like Chennai, Calcutta, and Mumbai, or the person making the will or owning the property is residing in these areas. Otherwise, probate is not required. As far as the execution of will by NRI for property in India is concerned, a person residing in California can also make a will of his property in India while sitting over here. He can draft the will, he can get the will considering all these points, and he can get it notarized here. And that will be considered as a valid will. He need not go to India to make the will or get it registered over there. As far as the making of will in US is concerned, it is more simple and straightforward. One can even make the will and get it registered online. There is no fees payable for registration of will in USA. And one very important thing I have observed that once a will is registered, it is totally, not only it is kept totally confidential, but every year they send a SMS to the person that if any updation is required, he can go for updation of the will. As far as the tax laws pertaining to inheritance is concerned, in India, fortunately, now there is no inheritance tax. Previously, there used to be a tax on inheritance, which was called as state duty. But at the time of demise of Indira Gandhi, that act was abolished. Previously in India, we had wealth tax also on whatever wealth a person possesses as on 31st of March, that is the end of the financial year in India, one was supposed to pay the wealth tax also over and above income tax. That act has also been abolished. Previously, there was an act called gift tax. Whenever one used to receive a gift, even from his blood relatives, then he was supposed to pay gift tax. That act has also been abolished. If a person receives any gift of any amount from blood relatives, from father, mother, brother, sister, there are a list of 56 relatives. If a gift is received, say up to any limit, 10 crores or 5 crores or whatever the amount may be, he is not supposed to pay any gift tax because gift tax is not there, nor he is supposed to pay any income tax on it. But if a person receives any gift from a non-relative, blood relative, then that gift amount above 50,000 per year is added in his income, and at the slab rate, whatever slab is applicable to him, he is supposed to make the payment of income tax. Then one important tool as far as this succession and inheritance is concerned is the formation of trust. trust may be divided broadly into two categories: revocable trust and irrevocable trust. And trust can be created for the benefit of minor. And there are a lot of exemptions which are provided under the Act for formation of trust. In India, there is also a concept of formation of trust in favor of public at large. They are called charitable and religious trusts. And they are giving a number of exemptions for the formation of the trust, for the contribution which is made by the trust, and the income of the trust. One must consider the formation of the trust, particularly in the California and other states in USA, for the benefit of children. As far as the remittance of money to USA is concerned, there is an agreement between the Indian government and the US government, which is called DATT, that is Double Avoidance Tax Treaty. And according to this treaty, if the taxes are paid on any income in India, then on the same income, as a thumb rule, no tax is levied by the US government. But to this thumb rule, there are certain exemptions. In order to obtain the tax credit in USA, one must consider the exclusions. For example, if any income in USA is exempt, and if on that any tax is paid in India, then the question of exemption does not arise. On the contrary, if any income in India is exempted and the same is taxable in USA, then also the question of any tax credit does not arise. But in case the tax paid in India is more than the tax liability on that income in USA, then the person concerned will not get any refund of the taxes, excess taxes paid in India. But the excess credit can be carried forward as per US laws up to 10 years. That is a very beneficial provision. Now the question arises, if a person has any income in India or the sale proceeds in India, and he wants to transfer those remittances or income or capital to USA, then my sincere advice will be it should only be through proper legal channel. As far as the accounts of the US citizens in India is concerned, they are of, you all must are quite aware of it. There are two types, NRE and NRO accounts. There is tax exemption as far as NRE account is concerned. No income tax is levied on the interest, and there is no limit of transferring the amount from NRE account to USA. But NRO account interest is taxable, and if there is any remittance from that account to USA, then there are certain rules which are changes from time to time. In the case, RBI provides rules for that, and simultaneously US also placed on the rules for that. And for bringing the amount above a certain limit, a certificate from CA in India is required. And if the amount is less than a lakh of rupees or so, then a self-declaration in Form 3 is sufficient for the remittance. I have tried to cover the topic in short, and I will be too glad to have the queries. I have already received some queries in the chat box, so I will like to take those queries first.
Yeah.
What happens to long-term capital gains from selling shares of unlisted companies? For shares of unlisted companies, no exemption is provided in the Act. Only in the case of listed companies, if the shares are held for more than 1 year, then there is exemption up to 1 lakh of rupees. And if it is more than 1 lakh of rupees, that tax at a concessional rate is applied. As far as the long-term capital gain on sale of unlisted company is concerned, it will be treated as a normal income of the person and it will be taxed accordingly.
Any other live questions before we go to some other questions? That was chat. So,
There
पहले पूछ
is-
लेते हैं कि there are any live questions.
Okay.
There are like
Okay.
6 people on stream right now.
What are the tax implications for rental income in India? Like if we have a rental property in India,
Okay. Okay. Okay, that is a fine, very good question. As far as the rental income is concerned, suppose the rent per month is 10,000 rupees and the year it works out to be 1,20,000 rupees. So out of it, straightforward 30% is allowed on account of maintenance. No question asked, no proof is required. So 30% is deducted. That works out to be about 36,000. So 1,20,000 minus 36,000. Then out of it, the taxes paid to the local authority, that is municipality, that is deducted. Then whatever amount remains, out of it, if any interest is paid on the mortgage of the house property, it is then deducted. And whatever remains, that is included in the income of the person concerned and is taxed according to his slab. I hope I am clear.
well, but if the person is in US, right, then what income tax slab are you referring to?
Yes, in that case, the normal slab rate exemption is 2,50,000, and above that, the whatever slab percentage is applicable, that will be applied on his income. In the case of long-term capital gain, the slab rate will not apply, but a flat rate of 20%, as we have calculated in our example. First of all, that long-term capital gain will be calculated. It will depend whether the property is held for more than 24 months or less than 24 months. If it is held for more than 24 months, then it is treated as a long-term capital gain. If it is held for less than 24 months, then it is treated as short-term capital gain. Short-term capital gain is treated as a normal income. Previously, this period of holding the property was 36 months. A few years back, it is reduced from 36 months to 24 months. I hope I am clear.
Yes. Thank you.
Okay, so I'll take the first question from chat. So, should NRIs consider Indian law clauses in drafting their will and estate planning, assuming they don't have plans to go back to India? And the other side of that question is, if NRIs plan to retire in India, then how should their will that is drafted here change?
As I stated in my presentation, even while you are sitting in USA, you can draft your will according to the method and the taking the precautions which I have mentioned. You can get it notarized here. You can mention the beneficiaries which you want to mention therein. It should be properly attested, and you should appoint the executors, and it will hold good in India also. Because as far as India is concerned, there is no requirement that the will should be registered with competent authority in India. Even if it is notarized here, then it will be sufficient. At least my personal suggestions will be, you should get it notarized here. As per law, notarized will is not required, but it is advisable.
Okay. The next question was, does India have the concept of LLC, which is limited liability company, for tax purposes, bookkeeping, profit and loss deductions on individual entities rather than individual persons holding the property?
Yes, in India, basically there is concept of proprietorship. There is a concept of partnership. But few years back, the government has introduced in between one more thing that is called LLP, Limited Liability Partnership. There is no limited liability proprietorship, but limited liability partnership. And in order to have this entity, that is limited liability partnership, there must be more than one person. there must be at least two persons to form this LLP, and this is a form of organization which can carry on the business and can claim all the legitimate deductions which are allowable as per law, and will have to pay the tax on the net income.
Okay. Any questions from the stream? Yeah, I'm reading that actually. Seshu, Mridul, or anyone else before I go to the next question? All right, let me go to the next question. So can we keep and maintain investments and earnings in India and US completely separate without cross transfers? If yes, would taxes be easier without complications? How should inheritance be planned in such scenario? Like, is there something equivalent to irrevocable trust?
As far as investments in India is concerned, there is cross-checking nowadays, because in India, every investment is linked with the PAN, permanent account number. And there is the system of cross-checking between the Indian government and the US government. So one has to consider the fact that everything which is there in the India is known to the US government, and whatever is there is known to the Indian government. This is one thing. Second thing is, one can have his assets and investments in India, but if the income from those investments is above the exemption limit of 2,50,000 per year, he will have to pay the tax according to Indian system.
Okay.
So, can I follow up on this, if you don't mind?
Yeah, go
I
ahead.
think, yeah, so I think a usual trend is that I have, for example, parents in India, right? And if they are not, if their income slab is below the, like in the 0% tax slab, right? Less than 5 lakh or whatever it is. So if I'm sending money to India, that is anyway tax free because I've already paid tax here. Now, with that money, if they buy a property, I don't have any tax implications if they are purchasing a property. Does it matter if it's in my name or their name to avoid any tax implications? And with the sale of that property, do you understand what I'm trying to say? So basically, I send money. Now, if they are purchasing a property with that, does it matter if it has to be in my name for my tax implications, or they can do whatever they want to with that money?
If you send money to your parents from USA, then
Yeah.
in the first instance itself, you must make sure whether you are remitting the money to them by way of gift or by way of loan. If you are remitting the money by way of gift, then no tax liability is attracted in India, and they can safely go by investing that income or the amount received in the property, and the property will be in their name. And as and when they will sell the property, then the normal tax provisions of long-term capital gain or short-term capital gain will arise in their case. Suppose if you send the money to them and they purchase the property in your name, then they will be simply acting on your behalf, and the property will stand in your name. So as far as Indian laws are concerned, normally NRIs are not promoted to purchase agricultural land or farmhouses, because in that event, if they want to sell, they cannot sell to another NRIs over there. If you purchase the property in your name, then all the tax implications of NRI as applicable will be attracted. Property
So
can be
it's better, yeah. So it's
subject.
better to have it in their name. And now, because they don't have any income, if I mean, if there's any, they can pass it on as a gift to their kids, right? Because
Yeah.
or as a ancestor, as a, they can transfer it to their kids. That can also avoid tax implications.
Yes, if your parents are having an income, they can very well transfer to their son or daughter. There is no tax implication on that, provided the son or daughter are major. That is, they are above the age of 18 years. If they
Correct.
happens to be minor, then during that period of minority, whatever income is earned on the gifted amount will be clubbed in the hands of the parents. And as soon as the the son or daughter becomes major, then that income will be taxable in their hands.
Fair. Okay. Thank you.
So the next question was, there is a myth talk that INR had track record of depreciation against USD and other currencies in the world. Hence, it is not worth investing in India and Indian assets if the core intention is to get the gains back to the US. Is that true? What are the experts' opinion on this topic? So I guess there are two questions in this, right?
So actually, as far as the tracking is concerned, a lot of laws have been passed in the recent, particularly by the recent government, and they are having a complete track on all the money which is coming into India and which is going out of India. So that is one thing. And second thing, as far as the valuation of the Indian rupee vis-a-vis dollar is concerned, it is very tricky question. A lot of things depends on the future, but the general presumption is that a dollar is going stronger and stronger every day.
So the second part of the question was, is it worth investing in India and Indian assets if the core intention is to get the gains back to the US?
In fact, there are two parts of it. First is as far as the appreciation is concerned. So as far as appreciation is concerned, it depends in what type of security you want to make the investment. If you want to make the investment in, say, real estate, so in real estate, particularly in the case of plots, the increase in the prices or the appreciation in the prices of the plots is very, very high. And it multiplies in a short period of time if you are able to find a proper plot from a proper person or in a proper locality. As far as the remittance is concerned, as we have discussed, the normal provisions will apply. But as far as the consequences of that appreciation is concerned, it depends. If the amount is invested in an asset which is not giving proper return and the dollar appreciates, then there will be a depreciation of capital.
Okay. That was the last question I have. Any other questions from Zoom? Or anything else you would like to talk about? Oh, one more question. So if a property is sold in India and long-term gain tax of 20% is paid in India, then if the remaining funds are transferred to the US, will it be taxed for remainder of US tax bracket, example 30%, minus 20%, or relaxed at 30% in the US?
For that, you will have to examine both the options, and as per the double avoidance tax treaty, as I mentioned, you will be getting the tax rebate, and you will have to consult your CPA to check. There are two methods of calculating the exemptions, whichever is more beneficial to you, and whichever is more beneficial to you, then you can go for that. But certainly you will get the exemption.
So the exemption will be the 20% which is already paid.
Yes.
So the difference will then
it will depend. Then further type of exemptions or exclusions are there,
Okay.
as I have mentioned. So we'll have to go into the minor details before arriving at the final decision.
Okay. All right. Any other questions? We're 50 minutes into the stream. Anything else you want to?
How to verify or double check if we are declaring and paying taxes to both government? As far as the income tax in India is concerned, they are having Form 26S, and nowadays they have introduced TIS and the IS, in which they are providing all the information as regards the income and TDS. And when one files the return, then the income tax department cross verifies all the information from the data they are already having with them. On the same income, whether you are liable to pay any tax in USA or not, you will have to check it from your CPA over here. Double check if we are declaring and paying tax to both countries. Is there any catch-up facility in case we find that we have missed some declarations? As far as India is concerned, then there is an option given to file a revised return. And for filing revised return within 1 year, there is a liability of paying additional 25%. And if the revised return is filed after 1 year, but within the second year, then the additional tax liability is 50% and no penalty is levied. But if we miss the bus and the department comes to know about it, then the scale of penalty is very high.
Very good questions. Any other questions? I don't think. Let me check YouTube.
Chat box में कुछ है क्या?
Yeah, that's it. So this was the chat box.
Yes. Last question.
Yeah. Okay. If no other questions, any last things you want to?
So I had delivered a detailed lecture on drafting of will, tax planning, and that is available on YouTube. I will be sharing that YouTube with you. And as far as India is concerned, nowadays the tax system is very liberal in a sense. Tax exemptions are there. Income tax returns can be filed online. If you want to file the return while sitting in USA, you can file it online. If you are having your DSC, then you can verify it online. If you are not having DSC, then you can print the acknowledgement of the ITR file, get it signed and send it to Income Tax Office, Bangalore. And then that will be verified. And if there are any refunds, then that will be created in your account. And the system is very automatic and the old things are thing of the past. And the department is having a very good method nowadays. And people are very happy with the working of the income tax department as a whole in processing the returns, in getting the refunds. And every information is available on the site of the Central Board of Direct Taxes. So everything is very transparent nowadays.
Okay.
And if you have any questions, I have given the email. You can send it to on email, or I have also given the phone number. You can note it down and you can WhatsApp to me. I will be too glad to answer. And if you plan having any other webinar on any topic related to income taxes, I can have that webinar from India also. I will be too glad to do it.
Thank you. I think it was very helpful. Thanks for spending your time on this.
Okay, thank you all. Thank you.
Okay, thank you everyone. I think
thank you everyone.
We're done here, and
Thank you so much.
Yeah, so this recording will be on YouTube as well. I posted the link, but let us know if you have any other questions. All right, have a good evening.
Thank you. Thank
Bye.
you.
Thank you. Thank you everyone.